Welcome to this edition of M&A University, presented by PCE Investment Bankers. How COVID-19 impacts EBITDA, a new financial metric in post-COVID world. In today's video, you'll learn the importance of tracking expenses related to coronavirus to defend a higher business valuation. I'm Mac Moran. I'm an associate for PCE Investment Bankers based at our New York area office. PCE is an investment bank providing M&A and ESOP transaction services to middle market businesses. Recently, there's been a meme circulating social media of a coffee mug reading EBITDA, earnings before interest, taxes, depreciation, amortization, and coronavirus. While this image was likely started as a joke, many suspect the new metric will be used by companies to reduce the impact of coronavirus to their financial performance metrics and ultimately their valuation. In simple terms, EBITDA is a measure of a company's overall financial performance and is used to estimate cash generated by the business. EBITDA will be adjusted for add backs to better account for the company's financial performance. Add backs are typically non-business related expenses or non-recurring extraordinary expenses that wouldn't have been incurred typically, such as personal expenses of the business owner or a one-time legal expense. EBITDA plus add backs adjustments equals adjusted EBITDA. This excludes the distortions caused by these irregular expenses that would not have been needed to operate the business. I recommend you check out M&A University videos, What is EBITDA, and add backs for a deeper understanding of these topics. Since the coronavirus pandemic is an unusual event, it stands to reason that many businesses and financial analysts will consider pandemic-related expenses as adjustments to EBITDA, which would result in adjusted EBITDA. Why is EBITDA important? From a management perspective, EBITDA is important because it provides a better measure of performance. By excluding these expenses related to the pandemic that were uncontrollable, management will have a better understanding of how the company performed. From a valuation standpoint, EBITDA is important for defending a higher valuation. The market approach to valuation relies heavily on EBITDA and EBITDA multiples, so incorporating these adjustments will help defend a higher valuation. We recommend that every company keep track of their COVID-19 expenses and losses so they're easily identifiable and supportable as add backs. Excluding the coronavirus's impact will present a clearer picture of your business performance and defend valuations. As you consider adjustments due to the pandemic, it's important to keep track not only of extraordinary expenses, but also issues that might have created delayed or lost revenues due to the pandemic, such as vendor shortages, delayed customer orders, mandatory closures of brick and mortar establishments, reduced production due to safety concerns, illness, or other issues related to the pandemic, disinfectant costs to clean property and equipment, IT costs related to transitioning employees to work remotely, or terminated contract fees. It's important that you track these expenses as they're incurred so you have a clear documentation of these expenses. If you sell your business, a buyer will heavily scrutinize these expenses or adjustments, so it's important to keep well-documented records. If a valuation is based on the trailing 12-month or TTM performance and you don't make these adjustments, you'll need to wait for the impacted months to roll off the TTM for it not to impact valuation. Trying to retrace or recreate these expenses or adjustments years later will be very difficult, and the true expenses will blend into your company's income statement. I'd suggest setting up a separate general ledger account to track these expenses and to document narratives related to these expenses. The impact of COVID-19 on EBITDA. Since EBITDA is such a critical component to the market approach to valuation, it's critical that you adjust it for these expenses. The market EBITDA multiple seen in the public markets is applied to your company's EBITDA to estimate its value. So the greater your company's EBITDA, the higher the valuation. Let's look at an example. ABC Company generated $5 million in EBITDA and operates in an industry trading at an average EBITDA multiple of 8 times. That means that companies in this industry, on average, have enterprise values of 8 times their EBITDA. Before any adjustments to coronavirus, ABC Company would be valued at $40 million. But throughout the year, this company had expenses related to the pandemic that impacted their EBITDA. Their management tracked $1 million of expenses related to the pandemic. When adjusting EBITDAC, they'd have $6 million in EBITDAC. When applied to the 8 times multiple, the valuation would be $48 million. That means there's $8 million of value attributable to the coronavirus add-backs. If management had not tracked these expenses and sold the business, they could have missed out on $8 million worth of value. So you can see it's very important that they kept track of these expenses. Thanks for joining me today. I hope you found this information useful. We welcome your comments and questions, so please feel free to contact me at my information listed here. And if you like this presentation, please subscribe to our YouTube channel so you'll be notified whenever new content is posted. Thank you.